A very good evening to you all, friends. I am Sanjeev Singhal, Central Council Member, Chairman, Auditing and Assurance Standard Board, and the Public Relation Committee of the ICAI. I welcome you to this 103rd program of the AASB for this council year. And today's topic is auditing aspects in Schedule 3 and the interplay with CARO. Friends, we know that Schedule 3 is mandatory for the preparers of the financial statement. And in CARO 2020, many additional requirements have been inserted, wherein the auditor is required to adopt or to report on those requirements. And similar requirements have been added for the management also to give those disclosures. So there is a strong linkage between the auditing aspect of such requirement along with the presentation in the Schedule 3. So we thought it appropriate to schedule a program on the same, which will cover that what are the key auditing aspects in Schedule 3, which have an interplay with CARO. And today we have with us expert faculty, CA Dr. Alok Garg, who contributes very well with the Institute of Chartered Accountants of India. He's a member in industry. And we also have chairman of the Bathinda branch with us, CA Gaurav Mittalji. And we're happy that Bathinda branch is co-hosting this program along with the AASB. That shows how forward-looking Bathinda branch is, which thinks that, auditing standards are very, very important for the members because auditing is our forte. Auditing is a profession which is exclusive to the chartered accountant. So I'm thankful to the entire Bathinda branch, particularly led by the chairman, CA Gaurav Mittalji, for agreeing to co-host this program. So may I now invite CA Gaurav Mittalji to give his opening remark and also, give a brief profile of CA Dr. Alok Garg and invite him to make his presentation. Thank you, Gaurav Bhai, and over to you.
Yeah. Good afternoon, everyone, and also thanks, sir, for your kind words. And today, on behalf of Auditing and Assurance Board of ICAI, I welcome all the esteemed guests, even our guest speaker of the day, CA Alok Garg ji. I think CA Dr. Alok Garg ji. Sir, welcome on the board. And friends, all we know today's topic is auditing aspects in Schedule 3, interplay with CARO. I think from the last 2 or 3 years, we see many and numerous changes in this topic, specifically in CARO and Schedule 3. And it itself makes this topic an important one for us. And auditing is also an identity of our profession. That's why today, I believe we will learn so many things from this session. And I am 100% sure Dr. Alok Garg we will learn from Dr. Alok Garg many new things related to audit of Schedule 3 as well as CARO. And before starting the session, technical session, let me introduce you with our guest speaker of the day, that is CA Dr. Alok Garg ji. CA Dr. Alok Garg ji is a member of ICAI since 2007 and is also a qualified company secretary from ICICI. He has more than 15 years experience in finance and accounts. He also renowned author of 4 comprehensive books and delivered more than 800 lectures on accounting standard, CARO, Schedule 3, Indias, etc. He also awarded with the National Education Leadership Award for Ramanuj College. The list is actually a never-ending one. So many achievements you have taken. So we have also limited time. And I will hand over you the mic, sir. Kindly continue the technical session. And again, thanks Auditing and Assurance Board of ICAI for giving us opportunity to co-host the program with you. Thanks a lot, sir. Please, sir, hand over to you, sir. Dr. Alok, sir, please.
Thank you, Gaurav ji, for the introduction. And I'm really thankful to CA Sanjeev Singhal, sir, who is my mentor also, and who is chairman of AASB for giving me this opportunity to speak on a right topic at the right time, right? Because people are preparing financial statements, and it's a time for audit when auditors are auditing the financial statement. And again, a very special thanks goes to Mr. Anil Lalji, because he is very prompt and I would say very punctual in arranging these topics, arranging these webinars, and coordinating with faculties.
Actually,
Anilji. And so, friends, today's topic is on Schedule 3 and CARO. And so, gone are the days when we are talking about Schedule 3 and CARO independently. Now, these Schedule 3 and CARO complement each other. So, I will be sharing my screen and will start my deliberation. I hope the screen is visible.
Yes, sir. Yes, sir.
yes.
Just allow me a minute. Yes. So I'll speak around 1 hour and 30 minutes on this topic, and I'll relate this entire Schedule 3 and CARO, that how these two topics will complement the management as well as auditors, right? So talking about financial statement is something which is the front running thing when anyone talk about investing in any company, when anyone talk about looking at the financial position or financial performance of the company, right? So let's talk about Schedule 3. And we are aware that last year we have a lot of amendments in Schedule 3, and there was a complete makeover of Schedule 3. When I talk about Schedule 3 is the responsibility of the management. We all agree with that, right? Schedule 3 is the responsibility of the management. And auditor's responsibility is to opine on the fairness of the financial statement, to and fair view of the financial statement. But if Schedule 3 is the responsibility of the management, whether it is not the responsibility of the auditor? Answer is no. It is responsibility of the auditor as well. Management responsibility is to execute the compliance of Schedule 3 while preparing the financial statement. Auditor responsibility is to ensure that the compliance of Schedule 3 has been complied with. If someone is not doing a compliance on Schedule 3, probably this will call for a misstatement in the financial statement, and this will call for a disclosure in the auditor's report, right? And when I'm talking about this misstatement is as per standard on auditing 450. So this SA 450 says that whatever is required by the regulation, if the company is not complying with those regulations, this is a misstatement as per standard on auditing. So talking about Schedule 3, it is a dual responsibility of the management as well as the auditor. Management is someone who will execute, and auditor is someone who will ensure the execution. Now, what about CARO 2020? So 2020 is the year when CARO got notified. And this CARO is covered under section 143 subsection 11 of Companies Act 2013. And when we are talking about Schedule 3 and it is something which is complied by the management, so CARO is something which is complied by the auditors. I mean to say CARO is the weapon which is used by the auditors to provide an opinion on the governance, to provide an opinion on the financial statement, to provide an opinion on the safeguarding of the asset of the company, to provide an opinion on the going concern, to provide an opinion on the internal audit system of the company, right? So this is something which is given by the auditors on an annual basis on the financial statement of the client or financial statement of the company. Now, before moving into Schedule 3 and CARO, let me talk about that how this CARO has been evolved and how this Schedule 3 has been evolved since beginning. So friends, earlier in 1988, when this reporting was introduced in the auditor's format, in 1988, there was a MAU CARO. And this MAU CARO was having 27 clauses on which auditors were doing the reporting. After 1.5 decades, this MAU CARO was revised and it became CARO 2003. So in 2003, CARO again got a complete makeover, and that time it was 21 clauses. In 2015, that is after 12 years, again, this CARO has undergone a lot of change. And that time, from 21, it becomes 12 clauses, right? So a lot of clauses have become redundant and a lot of clauses have been removed. Then after 1 year, there was a need that 12 clauses are not sufficient to report from the auditor side. So in 2016, there were 16 clauses and CARO got revised and 16 clauses were there around which the auditor has to report on the financial statement of the company. Friends, in 2020, and to be precise, on 25th February 2020, this CARO 2016 got amended and CARO 2020 got notified. So this CARO got notified on 25th February 2020, right? And in this CARO, 21 clauses are there. So there is a very, I would say, there is a very reasonable consistency in the clauses of this CARO 2020. And let me tell you, in CARO 2020, 21 clauses are there. And moving from 16 to 21, so one clause was deleted in this new CARO 2020. So there was a clause which talks about the remuneration, managerial remuneration section under 197 and 198 of the Companies Act 2013. So earlier in 2016 CARO, auditor is required to report on the appropriateness of the managerial remuneration to be calculated under section 197 and 188 of the Companies Act. But this reporting was already happening in the main body of the audit report, and hence the repetition of this clause was not required, and hence in CARO 2020 this clause was deleted. And now, while talking about 21 clauses, these 21 clauses are bifurcated into three parts: 7 plus 7 plus 7. What is the magic of this 7 plus 7 plus 7? 7 clauses are those clauses where no change was there. Means those clauses were there in 2016 CARO, as well as those clauses are there in 2020 CARO as well. 7 clauses are those clauses where the modification was there. Means in the existing clauses, there are some changes, right? So 7 clauses are as it is, 7 clauses are modified, and these 7 clauses are the newly inserted clauses. So 7 existing, same, 7 modified, some changes have been inserted in the existing clauses, and 7 are altogether new clauses, right? So let me take an example of all these 3 clauses, right? For example, when I'm talking about the new clause, right? Earlier, if the company is surrendering or disclosing any undisclosed income during the income tax assessments or during the raid by the department, that kind of disclosure was not there in 2016. So now auditor is required to disclose in its CARO 2020 report if there is an undisclosed income which is disclosed during the year during the income tax assessments. The second could be, for example, earlier the auditor were not required to report on the internal audit of the company, whether the company has an internal audit department and whether that internal audit system is commensurating with the size of the company. In 2003 CARO, this internal audit was there. Internal audit provision was there under CARO. But in 2016 and 15, it was deleted. In 2020 CARO, again, this clause was introduced. So these are the examples of the newly inserted clause in CARO 2020. Now let's talk about the modified clauses. When I'm talking about the modified clauses, right? So friends, in modified clauses, for example, while talking about the PPE, so earlier CARO says that the management is maintaining a particular proper record of fixed assets. The management is doing a physical verification. If there is any, discrepancy that has to be disclosed. So this is there in the CARO 2020 also. But in the clause 3 subclause 1, earlier it was only talking about property, plant and equipment. Now it also talks about intangible assets. For example, if you have a software, you have a server, so you have to maintain a record that your software is lying in which hardware, your server is lying where, what is the location, what is the identification of hardware in which the software has been there, it has been recorded, right? So these kind of details, these kind of physical verification, identification, this become part of the CARO 2020 in clause 3 and subclause 1. While reporting around the PPE, intangible asset was also introduced. While disclosing the fraud clause, right? There was a clause on the fraud. So whistleblower complaints has also been inserted in CARO 2020. So this is again an example of modified clause, right? This is again an example of the modified clause. Okay. Now talking about the existing clause. In CARO 2016, there was a requirement of commenting on the non-cash transactions, like whether the company has entered into any non-cash transactions with directors or persons connected with him, right? If so, whether the provisions of section 192 of the Companies Act have been complied with. So this requirement was there in CARO 2016 also. This requirement is there in CARO 2020 also, right? So this is the example where nothing has been changed. So in the first category of 7 clauses, this clause was there in 16 also, this clause was there in 20 also. The second example could be, earlier there was a requirement that auditor has to report whether the company is required to be registered under section 45IA of the Reserve Bank of India Act. And if so, whether the registration has been obtained. So this requirement was there in 2016, as well as this requirement is there in 2020. So I have taken 2 examples of each category: existing clause, modified clause, and new clause, right? So when I'll progress on the session, I'll talk more about this CARO 2020 and will relate this CARO 2020 with the Schedule 3. Now let's discuss about the journey of Schedule 3. Friends, prior to 2013 Companies Act, since beginning, we had a Companies Act to 1956. I know that in the audience, a lot of chartered accountant was having an experience of 15 years, 20 years, 30 years. So they are well aware about the Companies Act 1956. Friends, in Companies Act 1956, the format of the financial statement was there in the Schedule 6 of the Companies Act, right? And in 2011, and to be precise, on 25th February 2011, Ind AS were notified, right? So that time, India has decided to move on Ind AS, which are the IFRS converged standard. And on 25th February 2011, 35 Ind AS were notified. But that time, the preparations of the industry was not there. And that is why after 72 hours, on 28th February 2011, these 35 standards got deferred sine die. That time, when the introspection was done, we felt that, first of all, we need to align our format of the financial statement with the global financial statement. And prior to that date, the Schedule 6, which was there, it does not talks about the classification or bifurcation of assets and liabilities into current and non-current. And the global format of the balance sheet was that every item of the balance sheet has to be bifurcated into current and non-current. So that point of time, the Schedule 6 got revised and it becomes a revised Schedule 6. It was notified in February 2011, which was applicable from 1st April 2012. So first time in India, the format of current and non-current classification in the balance sheet was introduced effective from 1st April 2011. Friends, then the next step to converge IFRS standard and made it applicable to India, the next step was to have a major overhaul or have a major makeover in the Companies Act. So Companies Act 2013 was effective from 1st April 2014, right? And at that point of time, this revised Schedule 6 was converted to the new Schedule 3, right? And now it is Schedule 3, which was talking about the format of financial statement. Friends, to be precise, on 26 March 2014, the Schedule 3 was notified, which was applicable from 1st April 2014. And this Schedule 3, Division 1 to Schedule 3, that was nomenclated later on. But this Schedule 3 was applicable to the Indian companies, right? And I'm talking about corporates. For non-corporate, this format is not applicable because this format was notified in Companies Act. Friends, on 16 February 2015, Ind AS were notified, right? And Ind AS were the converged version of IFRS applicable to India. These Indian accounting standards were different from accounting standard, from our old accounting standard in terms of guidance, in terms of presentation, in terms of disclosure, in terms of nomenclature, in terms of terminologies, in terms of component of the financial statement as well. So again, there was two asks from the different regulators or the FICCI or CII or different industries, either to amend existing Schedule 3 or to introduce a new format of financial statement for Ind AS companies, right? And just to talk about an example, the concept of biological assets, the concept of bearer plant, it was not there in accounting standard, but it was there in Ind AS, right? So the concept of other comprehensive income, it was not there in accounting standard, but it was there in Ind AS. The concept of statement of changes in equity, it was not there in accounting standard, but it was there in Ind AS. The concept of correction, the concept of correction of prior period error by restating the financial statement, it was not there in accounting standard, but it was there in Ind AS. So there was a lot of deliberation at ICAI level, and finally the Ministry of Corporate Affairs has decided to issue a new Schedule 3 for Ind AS compliant companies. And with that, on 6 April 2016, a revised Schedule 3 was launched. It was notified. And at that point of time, we had two Schedule 3. And the existing Schedule 3 was categorized as or nomenclated as Division 1 to Schedule 3, which was applicable to the companies which are preparing their financial statement as per accounting standard. Which accounting standard? The accounting standard which is notified under Companies AS Rules 2006. Answer is no. As of now, when I'm speaking, it becomes Companies AS Rules 2021. There is no 2006 rules. It is 2021 rules now. Okay. So Division 1 of Schedule 3 is applicable to the companies which are preparing their financial statement as per accounting standard. Division 2 to Schedule 3, which was notified on 6 April 2016, is applicable to the companies which are preparing their financial statement as per Ind AS. Friends, then in the next year, on 30th March 2016, Ministry of Corporate Affairs has decided to implement Ind AS on NBFC companies like Bajaj Finance Limited, Bajaj Finserv Limited, right? Muthoot Fincorp Limited, so Sriram Transport Finance Company Limited, HDFC Limited. So MC has decided to implement Ind AS on these companies effective from financial year 2018-19. Friends, if I talk about NBFC companies, the kind of activities they are performing, the kind of business in which they are. So these NBFC companies have a different set of reporting, have a different set of terminologies which they use while preparing their financial statement. Right? Probably for a non-NBFC companies, the loans and advances could be there or could not be there. But for NBFC companies, the loans and advances is one of the, I would say, the major bread and butter in their business. So with that, again, the deliberation started. How to cater the financial statement of the NBFC companies. And let me tell you, if I talk about the small NBFC companies which are complying with accounting standard, probably the things are not quite different, but in Ind AS, the concept of financial and non-financial is there, right? So for every item in the balance sheet, when you are classifying those items or categorizing those items into current and non-current, again, you have to move ahead and you have to say whether it is a financial or it is a non-financial, right? And with that, the need was felt that we should have a different Schedule 3, different format of financial statement, which is more on the basis of liquidity to the NBFC companies. And with that thought, on 11 October 2018, we had one more version of Schedule 3, right? And this Schedule 3 was nomenclated as a Division 3 of Schedule 3, right? And this Division 3 of Schedule 3, which was notified on 11 October 2018, it was become applicable to the NBFC companies which are complying Indian accounting standard. Let me tell you, with my experience, there were 2-3 companies, NBFC companies, which were preparing their financial statement as per accounting standard. And their auditor and the management, so they have prepared their financial statement, the NBFC which is complying with accounting standard, and they have used the format of Division 3 to Schedule 3. Whether it was right, answer is no, that was non-compliance. Because this 11 October 2018 Schedule 3, Division 3 Schedule 3 is only applicable to the NBFC companies which are preparing their financial statement as per Ind AS. The NBFC companies which are preparing their financial statement as per accounting standard, they have to follow Division 1 to Schedule 3, right? So this is how we evolve in terms of presentation of financial statement. Okay, friends, now the things which we are going to talk about majorly on 24 March 2021. And before moving to 24 March 2021, let me talk more about the history. Friends, after 11 October 2018, when a lot of scams were started, were detected, a lot of frauds were happening, and it got detected by the regulators, there was a need to strengthen the governance on the company. So the regulators have started working on the governance of the company, that how the management and company will strengthen its governance part. But then the question arises that who will report on those governance? Who will tell the regulators? For example, I'm a management. Of course, I will say that I'm complying everything, right? And I have to comply everything which is required by the regulators and which is law of the land. But there is someone who will check these things and who will report to the regulators that yes, this company is complying with all the regulation which is applicable to this company. For example, when I'm preparing my financial statement, I'm saying that I have complied with all Ind AS as far as statement of compliance is concerned, right? In my accounting policy, in my notes to accounts, I'm putting a statement of compliance. But it is the auditor who will tell to the external world that yes, these financial statements are in compliance with the Indian accounting standard and the other regulation which is applicable to the company, and presenting a true and fair view, right? And that is why the first line of governance reporting started from the auditors to report on the financial statement of the company. And that is why on 25th February 2020, this CARO becomes more stringent and a lot of things were amended in the CARO. So friends, when I asked fellow members that why this CARO was deferred, so although it's CARO 2020, but it was applicable from 21-22. When I'm saying 21-22, it is applicable on the reporting for the financial statement prepared for the financial year 21-22. But it was notified on 25th February 2020, 26 days before the national lockdown, right? So when I ask my fellow friends that why this CARO was deferred for more than 1 year or to 1 year, they say that when this CARO was notified after 26 days, we had a national lockdown due to COVID, and that is why this CARO was deferred. Answer is no. If you look at the different clauses in the CARO, the newly inserted clauses, the modified clauses, you will feel that auditor is not an auditor, he is an astrologer, right? And this is something which is raised by the auditors lobby. Auditors has told MCA that you want us to report on the Benami properties, right? You want us to report on the Benami properties. You want us to report on the going concern appropriateness on the company on the basis of financial ratios. You want us to report on the whistleblower complaints. You want us to report on whether there is a evergreening of loans are there or not. You want us to report whether the internal audit is commensurating with the size of the company or not. You want us to report on whether there is an undisclosed income or not. But how do we get that information? We are the auditor. It's the management who is working throughout a year, and we are the auditor who is visiting the management premises. Of course, we are doing our due diligence, and we are sparing a time of, let's say, 2 months or 3 months in a year. So the auditors lobby has said that you want us to report on these governance matters. We are okay, we'll report that. But please make it a responsibility of the management equally. So how to make it a responsibility of the management? So they said that this has to be inserted in Schedule 3, because Schedule 3 is something which has to be followed by the management while preparing its financial statement. And friends, that is why the changes have been introduced in the Schedule 3. On 24th March 2021, and again it took a year to incorporate these amendments in Schedule 3. And that is why on 24th March 2021, the changes in Schedule 3 had been introduced. And the changes in Schedule 3 has been made applicable for the financial year beginning from 1st April 21, which means the first year for implementation of this revised Schedule 3 is financial year 21-22, right? Financial year 21-22. Right? So friends, and the companies have also applied this revised Schedule 3 to the comparative numbers as well. And let me give you a view here. As an auditor, the auditor has to report whether there is any undisclosed income which have been disclosed during the assessments, or it has been disclosed during the raid, which is there as per the Income Tax Act. The same clause has been inserted in the Schedule 3 also. The second example, the auditor has to give an opinion, or the auditor has to report on the appropriateness of the going concern assumption on the basis of the financial ratios. Now the point comes, who will calculate those ratios, right? Who will give the ratios? Who will say that, okay, the numerator and denominator of the ratios are this, is this and this? Who will say this? Because ratios are again subjective. And that is why 11 ratio were introduced in the revised Schedule 3 on 24th March 2021. 11 ratio was introduced, 11 financial ratio, right? And the management has to report the numerator and denominator of those 11 financial ratios in the financial statement notes to accounts. The management has to report if there is a more than 25% variance in comparison to the last year. The management has to report what is the reason for this variance, which is more than 25%. Third example, the auditor has to report that the management which has taken a loan, so whatever the quarterly returns they are depositing to the banks or financial institution. For example, if you have taken a cash credit or you have taken a working capital loan, you are required to submit stock statement, you are required to submit debtors and creditors statement to the banks. Now the auditor has to comment on that. Now the question arises that being a listed company, probably it is the auditor who is looking at quarterly numbers, who is performing the quarterly audit. But for unlisted company, where this quarterly financial statement or quarterly results is not required, how the auditor will take care of this reporting requirement? And that is why, friends, the same disclosure has been inserted in Schedule 3, in the revised Schedule 3, which was notified on 24th March 2021. Right? So now you understand that how this CARO 2020 changes has been inserted in the March 21 revised Schedule 3. I will not say there was an amendment. I will say that on 24th March 2021, this Division 1, Division 2, and Division 3 has become a new Schedule 3. Right? We understand the entire history and the background of CARO and Schedule 3. Friends, now the question arises, sir, why the changes in CARO was there? We understand that it was a requirement from the governance point of view. So it is required by the regulators, and why it was there. So of course, if you will look at 2 or 3 years back, there was a lot of resignations by the auditors. Although a lot of resignations are there also in the current era, where Byju's auditors Deloitte has resigned, where GT has resigned from another company, where EY has resigned from Azure Power, right? So this all is a public news. Friends, a lot of last minute auditor resignation were happening. And at that point of time, only management knows that why auditor is resigning. The entire public or stakeholders was not aware of the fact that why auditors are resigning. And that is why in the auditor's report, one of the clause was inserted. Clause 17, clause 18. Subclause 18 of clause 3 in CARO was inserted, where the auditor has to report, the new auditor who is reporting on the CARO, he has to report that why the auditor has been resigned. So whether there has been any resignation of the auditor, if it is not applicable, you have to say not applicable. It is not there, right? No auditor has been resigned during the year. But if there is a resignation of the auditor, then you have to report that whether the new auditor has taken into consideration the issues, objection, or concerns which are raised by the outgoing auditors. So being an auditor, the government has given a responsibility to the new auditor that you have to address the objection, concerns, or issues raised by the old auditors, right? And now this become your compliance as an auditor, right? Evergreening of loans. I'll not take the name of the company, right? And you all are aware about the name, right? And this was a case which was happened for just 5 years or 6 years back, almost 7 years back, right? Friends, what is meant by evergreening of loans? You have a old outstanding, so you'll get a new loan, fresh loan. You pay the old outstanding, and this new loan will become a new loan which you have just taken, right? So you'll pay the old loan from the new loan, and the aging will become zero, or it is just become a current. So friend, that was a problem, and the regulators have seen in a lot of companies this kind of evergreening was happening, and that is why the auditor has given a responsibility. They have to report if the company has taken a loan from the existing parties, right, and the company has settled or repaid the old loan from the same party, it is required to be disclosed in the auditor's report in terms of CARO. Going concern issues. Just 6 months back or a year back, the company was a healthy company, but suddenly the company was having a lot of going concern issues. I'm not saying that the going concern issues are not actual, or I am not saying that window dressing was there on a going concern issues, but auditor has given a responsibility that they have to report on the basis of financial ratios. On the date of signing the audit report, the auditor has to report whether on the basis of financial ratios, the company is capable of settling the dues or liability which is there on the balance sheet date within an year from the date of the balance sheet, right? On the basis of financial ratio. Corporate social responsibility, CSR. And friends, now you have seen that in May 2021, the SEBI has come up with a BRSR, right, which has become a mandatory requirement for financial year 22-23 for a listed company, top 1,000 listed company. And CSR is a subset of BRSR. CSR is a subset of ESG, environmental social governance, right? So you need to calculate CSR as per section 135 of Companies Act 2013, and you have to disclose a lot of things about, unspent amount, about spent amount, on which activity you have spent those amounts, what was your budget. If there is an unspent amount, it has to be, deposited in the specified bank account. Okay. So friends, again, the auditor has given a responsibility to report on the CSR, if there is an unspent money, whether it has been deposited in the bank account, that what is the, what are the CSR spends on the ongoing projects, on the non-ongoing projects. So these are the disclosures. These are the report requirement which was given to the auditors. Strengthening of the role of internal auditor. Friends, till 2003, in 2003 CARO, this requirement was there. But in 2016 CARO, this requirement was withdrawn. So friends, in CARO 2020, this role of internal auditor, because the internal auditor is someone who talks more about the processes. Internal auditor is like a business partner for the management. He talks about where is the leakage. He talks about the process leakage. He talks about how to improve the processes, right? So he is not giving any opinion on the financial statement. He is largely inclined towards the process improvement, and he is talking more about the SOPs and processes, the risk, opportunities. Okay. And for statutory auditor, it is important to understand that how the internal audit system of the company is working, right? What are the risks which is inherent in the organization, and what are the control mechanism to mitigate those risks, okay, or to identify those risks. And with that, this internal audit clause has also been inserted in the auditor's report, which talks about whether the internal audit system of the company commensurates with the size of the company or not, right? It talks about whether it commensurating with the size of the company or not. Loans and advances of the related parties, friends. Although Section 188 of the Companies Act, Section 185, Section 186, Section 177, it talks about the related party disclosures. It talks about the related party disclosure. I hope my screen is visible. Okay. Although it talks about the related party compliances, but again, the role of the auditor has been enhanced to report on the loans and advances given to the related parties, right? That what are the companies, what are the name of the companies, what is the relationship, what is the maximum amount outstanding, what is the amount of the loan which was given. So these things are required to be reported in the CARO reporting. Whistleblower complaints and frauds. Again, the clause number 11, the sub clause 11 of clause 3 was modified, and there this clause was inserted whether the auditor has considered the whistleblower complaints, if any, received during the year by the company. If you look at 4 or 5 years back, the employees of the Infosys Limited has raised an issue as a whistleblower complaints, right? So again, auditor has to take the cognizance of the whistleblower complaints in their audit report. Responsibility on the parent auditor to report in case of some adverse remarks in the subsidiaries. Friends, if I talk about prior to CARO 2020, the earlier CARO was not talking about the reporting requirement in terms of consolidated financial statements. If you will ask me how many clauses are there in the CARO, there are not 21 clauses, there are only 20 clauses. Why? The 21st clause talks about if there is any adverse remarks in the financial statement of subsidiaries, associates, and joint ventures, in that case, those adverse remarks is required to be reported in the consolidated financial statement, is required to be reported by the parent company's auditor in the audit report of the consolidated financial statement as a clause 21, subclause 21 of clause 3 of the CARO, right? So friends, due to these things, the reporting, the auditor's reporting was enhanced, and as a result, the management reporting was also enhanced. Wide change in Schedule 3 notified as per the notification dated 24th March 2021. So friends, let me talk about some non-compliances. And friends, recently in September or October 22, FRRB has released a material on non-compliances in the company's financial statement on Ind AS Schedule 3. So let's talk about some requirement and some non-compliances which are observed by FRRB as well. Yeah. Yes. Before that, I want to discuss one or two things on the balance sheet. So number one, on deferred tax assets or deferred tax liability. My question to the audience is, for example, the company has created a deferred tax asset, right? And friends, if you're preparing a balance sheet under accounting standard, AS22 is someone who takes care of the deferred tax accounting. AS22 says that if there is a virtual certainty and convincing evidence, then you have to create a deferred tax asset, right? And Ind AS 12, in Ind AS, it says that if the recovery is probable, in that case you can create a deferred tax asset. Now my question is, for example, on 31st March 2023, the company has created a deferred tax asset on the losses of the company. And prior to balance sheet, prior to board meeting, okay, let's say for the unlisted companies, they can prepare their financial statement and get it audited by 30th September, okay? 6 months window is there. So friends, prior to board meeting date, the company got huge orders in hand, right? And whatever the losses were there, the company has already earned 10 times more profit in comparison to the losses which it has incurred. Now my question is, this deferred tax asset which the company has already created, this deferred tax asset is going to be realized in the next year. Why? Because in the next year there are some profits. And in that case, this losses has to be adjusted from the profits, and the company will be able to recover this deferred tax asset. Whether this deferred tax asset has to be presented as a current or non-current. So let me give you the answer. If you are thinking that the company will be able to recover this deferred tax asset or realize this deferred tax asset within 12 months from the reporting date, it has to be seen as a current asset. The answer is no. As per Ind AS, as per accounting standard, or as per Schedule 3. Let me talk about Division 1, Division 2, Division 3, whatever it is. Deferred tax asset and deferred tax liability is always required to be shown as a non-current item, right? If it is DTA, it will be non-current asset. If it is DTL, it will be non-current liability, right? Now the second question is the capital advances. The company has given a capital advance. On 31st March, the company has given a capital advance for acquisition of property, plant and equipment, for acquisition of machinery. On 25th April, the company got the machinery and this advance got adjusted. Now my question is, whether this capital advance will be shown as current or non-current. On the balance sheet date 31st March 23, the company has given an advance of rupees 150 crores to the capex suppliers. And on 25th April 2023, the company got the PP, and this entire advance has been adjusted. So whether it will be a current asset or it will be a non-current asset. Friends, let me give you the answer. The capital advance will always be shown as a non-current asset. Why? Because the ultimate, going by the substance and looking into the destination of this item, the destination of this item is property, plant and equipment, which is the nature of the non-current asset. And hence, as per Schedule 3, this capital advance will always be a non-current asset. Doesn't matter, it is going to be realized tomorrow on 1st April, right? So this is something, the 2-3 item which I wanted to discuss. Let me talk about one of the important item, which is rounding off. And let me be very candid about this item. So friends, when I talk about 3 divisions, Division 1, Division 2, Division 3. In Division 2 and Division 3, this rounding off requirement was since beginning. Means, if you are a company who is preparing the financial statement as per Ind AS, you have to apply the rounding off provisions while preparing and presenting your financial statement. It is a mandatory requirement. It was a mandatory requirement since beginning. Even for NBFC company, this was a mandatory requirement which is following Ind AS. But in Division 1, the companies who are preparing their financial statement as per accounting standard, this requirement was not mandatory. And on 24th March 2021, this requirement became mandatory. And what is the requirement? The requirement is, for example, if you have a revenue of, let's say, 246 crore, 25 lakh 28,231. Let's say you have this revenue. Now the question comes that why this rounding off is mandatory. Friends, first of all, the financial statement has been prepared or is required to be prepared for the user of the financial statement. Who is the user? Who will use those financial statements in taking the decisions? Users can be regulators, investor, employees, creditors, anyone, right? Investor, anyone. Now the point comes that if a company has this kind of numbers, 246 crore, 28 lakh, 28,231, and they have to give the comparative also. So do you think that how this page will be look like? It will have a lot of long numbers. Will you be able to read this number quickly? The answer is no. But if these numbers have to be presented in a rounding off, taking a rounding of criteria, and this will shown as 246.31 crores, and all the numbers are in crores. How do you feel now? You will be able to read these numbers quickly, right? You will read this number quickly. And probably if you will miss, let's say when you are typing, you will miss this one. Probably there could be some issue, right? Because when you are typing a long numbers, there could be a problem. So friends, that is why this rounding off become mandatory for the companies who are preparing their accounts as per accounting standard also. And this requirement is a mandatory requirement. Number one, the non-compliances were observed in terms of the company are not doing the rounding off by taking a right set of the rounding of thresholds. For example, the rounding of threshold which is given, if the company has a total income of less than 100 crore rupees, less than 100 crore rupees. If the total income is less than 100 crore, the company can round off to the nearest 100,000, lakhs or millions or decimal thereof. So in this case, either you can round off as a 246 or you can round off as a 246.31. Okay, friends, if you have a total income of 100 crore, more 100 crore or more, you have to round off nearest lakhs, millions or crores or decimal thereof. Friends, if you see, the lowest number is lakhs here. The lowest rounding of threshold is lakhs. Still, there are some companies which have rounded off in thousands or they have rounded off in thousands or hundreds. The point is, while as an auditor, when you are looking at the financial statements, or as a management when you're preparing the financial statement, you have to take the cognizance of this provision which is given in the schedule 3, that what is the total income of the company. Earlier this threshold was on the basis of the revenue, but now this threshold is on the basis of the total income. And what is meant by total income? Total income means revenue from operations plus revenue from operations plus other income, right? Is that okay? Okay, so this is about rounding off. Then come to the second important disclosure, friends, and which was around the shareholding of promoters. Now the question arises, sir, what's changed now? For example, earlier we were doing the disclosure of the share capital or the shareholders who are having more than 5% equity share capital of the company, right? This disclosure was there. So whether that disclosure is still there, answer is yes. So friends, that disclosure was required only when the shareholder is holding minimum 5% of the equity share capital in a company. But this disclosure is regarding the promoter shareholding. And why this disclosure was important? This disclosure was important because when I am, as a user of the financial statement, when I'm looking at a financial statement of any company, I will not be able to understand whether the promoter are diluting their interest or not in the company, right? Whether the promoter are selling stake in the company or whether the promoter are increasing stake in the company, right? So I will not be able to understand. So friends, that is why it was important to see that whether the promoter are losing confidence or promoter are gaining confidence or promoter are consisting with the confidence in the company. This disclosure was required, and that is why this disclosure was inserted. And what is the disclosure? Irrespective of the holding, for example, there is a promoter who is holding 0.001% of the share in the company. that disclosure is required. And what is the disclosure? Name of the promoter, number of shares he holds, or number of share it holds, what is the percentage out of the total shares, and if there is any percentage change, that is also required to be disclosed from the current year vis-a-vis the last year, right? So this is the disclosure which is required for the promoter shareholding. So friends, the earlier disclosure was only for the 5%. For example, if the promoter holding is not there, but there are a lot of shareholders who are holding more than 5% capital of the company, in that case, that disclosure is still required. But this is a specific disclosure which only talks about the promoter shareholding. And let me show you Hindustan Unilever disclosure in the last financial statement. You can see this is the name of the promoters, right? And there is no change during the year. But they have disclosed 2.2%, 1.4%, 0.8%, 2.6%, 2.9%, 4.5%. So there are a lot of promoters who are holding less than 5% of the equity. Because you can ask, sir, even in earlier days, if a promoter is having more than 5%, it comes in the earlier clause, right? But if it is less than 5%, it not comes under the earlier clause. So that is why this different clause is there, right? So now the question arises, who is the promoter? From where you have to get the meaning of the promoter, friends. Promoter is defined as in the section 2, subsection 69 of the Companies Act. And to be precise, promoter is someone who is identified in the prospectus or the annual return of the company, okay, as per section 92, or as an auditor, you have to refer MGT 7, right, where you will get the details of the promoters of the company. Friends, promoters are those who has a control over the affairs of the company, directly or indirectly, whether as a shareholder, director, or otherwise, or in accordance with whose advice, directions, or instructions the board of directors of the company is accustomed to act, provided that nothing in subclause C shall apply to a person who is acting merely in a professional capacity. For example, let's say Mr. Narayan Murthy, or let's say Mr. Deepak Parikh. So Mr. Deepak Parikh is the founder member of the HDFC Bank, right? Let's say he's not holding any share in the company. Okay, he's not holding any share in the company. He's a chartered accountant. So friends, normally due to the aura or due to the experience of Mr. Deepak Parikh, the board is required to consult the board regularly consult with Mr. Deepak Parikh on some key issues of the company. Now the question arises, whether Mr. Deepak Parikh is promoter? Answer is yes. Going by the definition, going by the para C of section 2, subsection 69 of the Companies Act, Mr. Deepak Parikh is considered as a promoter of the company. Why? Because in accordance with the advice, direction, or instruction of Mr. Deepak Parikh, the board is accustomed to it. But Mr. Deepak Parikh is giving advice in the professional capacity. Mr. Deepak Parikh has a CA firm also, and he is charging from the company for whatever advice is giving. In this case, whether he is accustomed as or considered as a promoter, answer is no. He'll not considered as a promoter of the company, right? Friends, there is no disclosure requirement on this aspect in the CARO, right? But yes, this change was there in Division 1, Division 2, and Division 3. And the companies are required to disclose this fact or this table or this format in the notes to accounts, right? Security deposit. Friends, earlier the security deposit was part of loans and advances, right? And now the security deposit become part of the other financial asset. And let me give you a very layman language example here. Bharti Airtel has a turnover of, let's say, more than 1 lakh crore. And you have taken a Wi-Fi connection or broadband connection from Bharti Airtel. And you are giving a security deposit to Bharti Airtel for 1,500 rupees. Will you say that I have given a loan to Bharti Airtel? Answer is no, it is not a loans and advances. It is more in the nature of security deposit. More in the nature of security deposit. And that is why a lot of deliberation was happened, and it is the terminology which matters. And then it was decided that it is, although it is a financial asset, but it is not a loans and advances. It comes under the other financial assets, right? So that was the change which was happened. Now let's come to the non-compliances, and now this revised schedules become a 2-year baby, right? So last year was when I say last year, so I'm talking about 21-22. So that was the first year. 22-23 is the second year. So this revised schedule 3 become 2-year baby, but still lot of errors, lot of non-compliances are still happening, either because of the lack of the knowledge or because of, the people are not getting updated or they are not referring this schedule 3 or CARO again and again. My request and my recommendation is, please go through with the entire schedule 3 format when you are preparing the financial statement again, right? And please read the FRRB observation on the non-compliances as well, so that you will have a view that what kind of mistakes people are committing in the schedule 3. Friends, the second change is again a very classic change, and I would say it is one of the most demanding change. Friends, if you have taken a loan for a period of 5 years, for the first year or for the within 1 year payment, you are showing it as a current obligation, and for the payments which is beyond 1 year to 5 year, you are showing as a non-current, right? And in the current, you are showing it as a different line item. So for first beyond 1 year to up to 5 year payments, you are showing as a borrowing, long-term borrowings. But within 1 year payment, you are not showing as a current short-term borrowings, you are showing as a current maturity of long-term debt to be shown as a other financial liability. If I am a non-finance background person, but I am a shareholder of a company and I got an annual report, now the question arises, when I'm looking at the borrowing situation of the company, I will not be able to connect, whether my borrowing is increasing or my borrowing is decreasing, right? The classic example is, let's say the company on 31st March 2022, the company has a long-term borrowing, LTB, long-term borrowing for 1,000 crores, right? And this entire borrowing is beyond 1 year, right? When I say beyond 1 year, it is 1 year, beyond 1 year, less than 2 years. When I'll come to 31st March 2023, this long-term borrowing becomes zero because everything will come under the current maturity, which is within 1 year, and this will go under the other financial liability. 1,000 crores, right? Now, when I'm looking at a balance sheet, what perception I'll make while looking at the face of the balance sheet? I will say that, oh, the company is repaying all its debt, right? Because when I'm looking at a borrowing, everyone understands the meaning of the word borrowing. Being a doctor, being an engineer, right? So I am saying that the long-term borrowing is zero. Then I'm looking at a short-term borrowing. I'm saying, oh, this is also zero because this is sitting in the other financial liability. In the current asset, it is sitting in the, in the current liability, it is sitting at the other financial liability. Now, friends, this thing has been changed. To give a more fairer view and more transparent and upfront view to the user of the financial statement, this has been changed. And now this other financial liability, this current maturity of the long-term debt has been deleted from the other financial liability, and it has to be shown under the short-term borrowing. So now what will happen? Now, when the user of the financial statement will look at my financial statement or any company's financial statement, he will see, okay, this 1,000 crore liability, the borrowing was there in the last year, and this 1,000 crore is in the current year also, right? As a short-term borrowing. It means the overall borrowing of the company has not been changed. It has not been reduced. It is still 1,000 crore, right? And that is why this change was happened. And I would say very logical change. Okay. Now let's talk about again a very governance related matter. Aging for trade payable, aging for trade receivable, and aging for savable. Now, when I discuss with my fellow friends and my fellow chartered accountants, and last year when this schedule 3 was changed, I took around 11 or 12 sessions on different part of the country on the schedule 3. And when I was deliberating on this schedule 3 in Gorakhpur and in Varanasi, I have asked that, do you think that this aging will change your life? So many chartered accountants says that no sir, we don't think so. So this is just a simple disclosure. हमें सिर्फ उसका जो भी creditor है उसकी aging बतानी है. Then I have again reiterated my question that do you think that it is very simple? And then I have asked one thing, that why regulator wants this aging? Why regulator wants this aging? Friends, first of all, let me talk about what is the requirement of the standard of the schedule 3, and where the companies are lacking and where the auditor are not doing their proper documentation in terms of these aging. So friends, the new disclosure requirement is, first of all, whatever creditor you are showing, you have to bifurcate that creditor into MSME party and other than MSME. So that we were doing also on the face of the balance sheet. Yes, you are doing that, right? So first MSME, dues to MSME and other than MSME. Second, the regulator don't only want the MSME aging and other than MSME aging. They want you to please bifurcate into disputed as well as undisputed. Which of the trade creditors are disputed and which of the trade creditors are undisputed, right? So first MSME and other than MSME, then disputed and undisputed. And friends, you have to give this bifurcation, and as far as aging is concerned, you have to provide the aging which is less than 1 year, 1 to 2 year, 2 to 3 year, more than 3 years, and the total, right? And you have to give the aging from the due date of the payment, from the due date of payment. Okay. So in many cases, the company is agreeing the due date of payment with the vendors and suppliers in the purchase order or in the agreement itself. Sir, what happens if the due date is not there? In that case, you have to take the date of transaction, date of invoice, date of transaction, right? Sir, can I take the due date of payment as a date when I'm booking my invoice in my accounting software? Answer is no, right? Answer is no. So basically, you have to again draw an analogy that what is given in the different regulation. For example, there is a MSME Act 2006, which says that for MSME parties, you have to pay them within the due date of payment, and the due date of payment is 45 days. 45 days from where? When? 45 days from the date when you have accepted the goods and services. Means date of invoices, right? So friends, now the point is, you will provide this aging from the due date of payment if it is available, or date of invoice if it is not available, then date of invoice, date of transaction, right? Or date of GRN. Okay. So friends, you will give this aging. Now what regulator wants, and what is your role as an auditor? Your role as an auditor is to understand, let's say the company is showing accrual, or the company is showing a trade creditor which is more than 3 years. Okay? First of all, if it is MSME, then as an auditor, you will see that, okay, if it is MSME and we are disclosing it in more than 3 years, more than 2 to 3 years, or more than 1 to 2 years, whether it is matching with my half yearly return, which I'm filing for MSME. Second, whether I have created enough provisions for MSME, whether I have created enough provisions for MSME. Interest provision, right? Which is 3 times of the bank rate. Third, if there is an outstanding for more than 3 years to MSME or others, and which is undisputed, Now the question arises, why this is outstanding? Do you think, or can you guess something fishy about this? Friends, tell me one thing. If it is a cash-rich company, this company is paying to everybody, then why the company will not pay to the creditors whose amount is outstanding for more than 3 years, right? And when the law of limitation has also been passed, then why you will not why you will not pay that creditor? Is it an actual transaction or is it a bogus transaction? So that was the thinking of the regulator for asking these kind of aging. As an auditor, you need to do the documentation. Whether the management is showing rightly as a undisputed, probably it would be have been disputed. If it is disputed, the court case is going on, the litigation is going on, then fair. Right? You will not pay till the time the verdict will not come. Then that is okay. But the point is, when you are disclosing this as a management and you are verifying this as an auditor, probably the proper documentation should be there, right? Proper justification should be there. And you need to look at the classification of these parties as well. Another example. So many companies, when they are providing this disclosure, right? So the classic example, or even in guidance note, it is written that this, let's say if you are talking about trade payable, it covers two things. One, trade creditor actually means where the invoices have been booked, and the accrual as well. Accrual, okay? It is the aggregate of these two items. It is the aggregate of these two items, okay? Friends, but this only talks about trade payable. It does not talks about accrual. When someone has not raised you invoice, how will you say that it is due? It is due for the payment. So friends, in that case, number one, while presenting this thing in the notes to accounts, you will give the aging of the trade payable, and in the last line, you will write as a accrual, okay, accruals, and you just put the number just below the total, and this total should be tally with the tie with the balance sheet number, right? This is what you need to disclose. Many companies are not disclosing, but this should be disclosed. That is number one. Number two, as a policy, this disputed and undisputed should be defined. So disputed should be defined, right? Number three, so when as an auditor, you are looking at this financial statement in the notes to accounts, so you are very much, comfortable about this aging, which is beyond 3 years, right? So you can advise to the client or to your to the management to just write back these creditors if it is not disputed and someone is not asking the money actually. Okay, so this is what regulator wants. The another non-compliance which I want to tell you, there are few companies which we have noticed. Let's say if I talk about this MSME and non-MSME, there are three disclosure which is required for MSME. Number one, on the face of the balance sheet, right? Number one, on the face of the balance sheet. Number two on the as per section 22 of MSME Act 2006. There is a disclosure which is required that what is the principal amount outstanding, what is the interest amount outstanding, and those 5 disclosures are there for the MSME entities. Number 3, this aging of MSME other than MSME. Friends, when we are preparing our financial statement as an auditor, when we are checking the financial statement, we are tying the number on the face with the notes to accounts, right? Notes to accounts means schedules. कि इसका टोटल उसके फेस से टैली होता है या नहीं होता. But if the same disclosure is at different places, you have to ensure as a management as well as an auditor that the number speaks that disclosure speaks a single number everywhere in the financial statement. So there were places where the number on the face of the balance sheet is matching with the schedule, but it is not matching with the disclosure which is given as per section 22 of MSME Act 2006, right? So within a financial statement at 3 places, the same number has been called for, but the same number is not speaking the same language at all the places. So you have to be very considerate about these kind of disclosures. This is the disclosure of TVS Motors Limited, and let me show you. This is how they have disclosed MSME, others, disputed, undisputed. So there is nothing on the disputed side. And in the total column, they have given the accrued expenses, and this total is tallying with the balance sheet face. Now let's talk about the aging for trade receivables. So friends, again, this change was there in division 1, 2, and 3. And let me talk about this particular disclosure. The same thing. that if it is it is undisputed, data is there, right? And the aging is less than 6 months, 6 months to 1 year, 1 to 2 year, 2 to 3 year, more than 3 year, right? Then why this data is not giving you the money, right? If it is undisputed. I'm not saying that the money will always be there, or if you are not getting a money for more than 3 years, that will be a bogus transaction. I'm not saying that. But as a management, you should have a proper justification. As an auditor, you should have a proper documentation. I think that's the key, right? Again, the disclosure requirement is you need to bifurcate this trade receivables into various parts. If it is a division 1, when you are complying with accounting standard, then probably you have to provide this undisputed and disputed. Undisputed considered good, disputed considered good, undisputed considered doubtful, disputed considered doubtful, disputed considered doubtful. Okay. But if you are preparing the financial statement as per Indian accounting standard, apart from considered good, considered doubtful, there are 2 other categories as well. What are 2 other categories? The third category is significant increase in credit risk. The fourth category is credit impaired, right? The fourth category is credit impaired. For example, the credit rating of the customer is deteriorating. In that case, you may sense that there is a significant increase in credit risk. But let's say if the customer went to NCLT, it become bankrupt, probably it will be a credit impaired cases, right? So again, as a management and auditor, you have to be very meticulous about the way you are calling something as a considered good, the way you are calling something as a considered doubtful, the way you are calling something as a significant increase in credit risk, or the way you are calling something as a credit impaired. I think this is very, very, very important thing, right? So friends, again, the due date of payment is as per the contract. If the contract is not there, probably you will take the date of transaction. Let me show you the real disclosure from Tata Steel annual report. It is something where they have disclosed undisputed considered good, undisputed credit impaired. Also, you can see that although this is more than 3 years, right? But what they can do if it is credit impaired, if the customer is not solvent enough, the customer is not having a capacity to pay, how he will pay, right? And you can see that there is a allowances for credit losses also. So the company has already taken the allowances for credit losses also, right? But again, the regulator or user of the financial statement wants to understand that how much amount is credit impaired, what's the gross and what's the PTD, provision for doubtful debt, right? Before this, let me talk about capital work in progress. So at times people used to ask, sir, capital work in progress, whether it also includes intangible asset under development? Answer is yes. If something which is tangible, it may be called as a capital work in progress. If something which is intangible, it may be called as an intangible asset under development. But the point is, the CWIP is a in progress part of tangible, and the under development is a progress part of intangible. Friends, earlier the people used to, or the companies used to disclose the CWIP in the balance sheet, right? And mostly they are just doing the reconciliation of those CWIP in terms of what is the gross opening, what is the addition, what is the deletion, and what is the closing balance, right? With their PP schedule. Now, what happened? Let's say the company has a big projects. Like I am a shareholder of a company. So my interest is to understand if the company has a lot of projects, what is the status of those projects, right? In terms of the aging, that how old are those projects, right? For example, if the company has a CWIP of, let's say, 1,000 crores. So what is the aging of that 1,000 crores? If you will say that it is more than 3 years, right? So whether the company is capable of completing the projects in time, because if the company will complete the projects in time, the revenue generation will be started. Okay. So that is number one. Number two, the user or stakeholder wants to understand that the projects which is there, the CWIP which is there. So what is the overrun in terms of time and in terms of budget? For example, if you are thinking that, or you are budgeting that, in this project, it will take around 500 crores, right? I'll invest 500 crores and this project will be completed. And suddenly, instead of 500 crores, it took around 800 or 850 crores. So again, this disclosure was also required, that how many projects are there, right? And what is their aging, and what is the budget overrun, where they have exceeded the budget. Second, the project timeline was in case of infra companies, where they are constructing bridges, tunnels, dams, hospitals, roads, where they have given a timeline. For example, they have said that we will complete this project by 31st March 2024, or in the next 2 years. So question arises that whatever timeline or deadline they have taken, so what are the projects where they have done the time overrun as well? They have exceeded time, right? So this kind of disclosure is also required in capital work in progress. You can see that I have shown you the Hindustan Unilever Limited disclosure, where they have disclosed the project in progress and project temporarily suspended. And again, another disclosure requirement is in the CWIP. If CWIP is related to the projects which is temporarily suspended, you are required to disclose those things as well, those numbers as well, so that someone will be able to understand if it is temporarily suspended, right? Then why it has not been impaired, and what is the fate of this project already suspended, right? When people will not have the information, they will not raise the right set of questions. Okay, when they will have the information, then they can ask the question. Then they have disclosed project which have exceeded their original timeline, project which have exceeded their original budget, right? And here, budget overrun, right? They have disclosed the budget overrun. They have given the aging also, and they have given the name of the project: Kolkata factory, Assam factory, Kandla factory, Rajamundra, Khemagaon factory, and others. This is for the progress, and this is for the suspended. You can see this disclosure, right? They have given quite a detailed disclosure in terms of so basically, which has exceeded cost compared to the original plan as of 31st March 2021. It was nothing, right? But whose completion is overdue in terms of time, they have given the disclosure. So time overrun they have given, but the overrun they are saying it is immaterial or nothing is there, right? Okay. So any questions so far, Anilji?
Yes, sir.
Shall I take at the end of the session?
So you are not audible.
Am I audible?
Am I audible?
Sir, you have concluded?
No, I have not concluded. I'm just asking if anyone has questions so far.
Sir, actually, we have question right now, approximate.
Few questions are having with the chairman, sir.
Sorry?
Sir, few questions are having, chairman, sir, is having few questions right now.
So then in the next 15 minutes, I think I'll conclude and then I'll take the...
Sure,
Yes,
sure,
sir. Yes,
sure,
yes,
sure.
sir. Yes, sir. Yes, sir.
Yeah. So talking about another disclosure, the disclosure with respect to immovable property, right? So friends, again, this thing is very important, and we have seen that in a lot of cases where the amalgamations are happening, the merger and acquisitions are happening, right? But still the title deed is lying with the original acquirer, right? And it is not getting transferred in the name of the company. So again, this was one of the area where from the governance perspective, the regulators needs to understand that what are the immovable properties where the title deeds are not held in the name of the company, right? And hence the disclosure was required that the relevant item in the balance sheet. And why this relevant item in the balance sheet is important, because there could be a immovable property. Let's say if the immovable property is using for the business premises, for using for the business purposes, it has to be shown as a property, plant and equipment. if the immovable property has to be taken for the capital appreciation purposes or has to be taken for the rental purposes, it has to be shown as an investment property, right? Okay. And if that immovable property is retired from the active use and held for disposal, okay, so this language is as per accounting standard, but if it is held for disposal, the right language under Ind AS is non-current asset held for sale. Or others could be your if there is a leasing of land and building, the lessee has taken a land and building on the lease basis, so it talks about that right of use asset, right, whether the title deed in terms of that lease deed is there or not. Okay, then the description of the items of property, then the gross carrying value, title deed held in the name of whom, okay, and whether title deed holder is a promoter, director, or relative of the promoter, or director or employee of the promoter or director. So that is also required to disclose. And property held since which date, right? It is also required to be disclosed. And the reason for not being held in the name of the company, that is also required to be disclosed. And friends, this requirement has been given in the CARO as well, right? In the Schedule 3 as well as CARO. And I have a real life disclosure from the Tata Steel where they have disclosed the description of the property, the gross carrying value, and this property is held in the name of whom, okay? And whether promoter, director, or the relative or employee, right? Period held, and the reason for not being held in the name of the company. Like you can see that this land is held in the name of Bhushan Steel, right? Erstwhile Tata Steel BSL Limited, Bhushan Steel and Strips Limited, Tata SSL Limited, and these properties have not been transferred in the name of the Tata Steel Limited. Why? Because these properties are acquired through amalgamation or merger. Okay, so the name change is pending, right? And these properties are very old properties like 1928 or 1960, and they are upfront in saying that the title deed is not available with the company. Friends, one more disclosure was there in CARO as well as Schedule 3, Division 1, 2, and 3. And it was, for example, if the company is doing the revaluation of its property, plant, and equipment, right? So number one, are you getting this revaluation through a registered valuer or it is not through a registered valuer, right? So I think that is required to be disclosed, number one. So whether this revaluation is based on the valuation by a registered valuer. Okay. Number two, if while doing a revaluation, your net carrying value, I'm not talking about the gross value, your net carrying value exceeds by more than 10% of the earlier value, in that case, the disclosure is also required in Schedule 3 as well as in CARO. Now, friends, if I talk about Accounting Standard 10 in AS and Ind AS 16, in Indian Accounting Standard, there is Property, Plant, and Equipment Standard. It says that if there is a revaluation, irrespective of the limit, whether it is 10%, 2%, 3%, irrespective of the limit, if there is a revaluation, in that case, the disclosure is required. Okay, the disclosure is required. Now the question arises that in the financial statement, whether the company has to disclose only when the revaluation resulting in more than 10% of the change in the net carrying value, or if the change is less than 10%, still this disclosure should be there. So friends, if there is some requirement of Schedule 3 and some requirement of Indian Accounting Standard or Accounting Standard as well, then you have to apply the rule of harmonious construction. And of course, between Schedule 3 and Ind AS, if Ind AS has more requirement, then it will prevail, right? So in that case, in Schedule 3 financial statement, even though if the change is relating to 1%, 2%, or whatever number which is less than 10%, it is required to be disclosed. Okay, that is one. Now coming to the next requirement. So loans or advances granted to the promoters, directors, KMPs, and the related parties. Friends, in some way or other, the SEBI LODR requires this kind of disclosure in the listed company's financial statement. But Schedule 3 is applicable to all the companies, be it a listed companies, unlisted companies, private limited companies, everyone. Friends, when the company is giving a loan or advance to the promoter, director, KMPs, and related parties, so you have to disclose the type of the borrower, right? That whether it is given to the promoter, given to the director, KMPs, or related parties. Now the question arises, sir, if I talk about the related parties, whether I need to look at from the perspective of, section 2 definition, which is given for the related party, or should I refer Indian Accounting Standard 24 if it is the Ind AS, or AS 18 if it is AS? So friends, my recommendation, my suggestion is, again, you have to look at the related party from the perspective of Ind AS as well as from the perspective of Companies Act. You should take higher of two. Okay. So for these kind of related parties, you need to provide the disclosure of amount of loan or advance in the nature of loan outstanding and the percentage of this amount, right, with the total loans and advances. So this thing has to be given in the disclosure, in the notes to accounts. Okay. And friends, the same disclosure, I mean to say the same reporting is there from the auditor perspective, right? If the loan or advances is given to the promoter, director, KMPs, or related party, it is required to be disclosed in the CARO. Talked about again detail of Benami property. So this disclosure is there in the CARO as well as notes to accounts in the financial statement, right? If there is any proceeding which has been initiated or pending against the company for holding any Benami property, as the name suggests, if there is no any proceeding, right, which has been initiated, you cannot name the Benami property. जिसका जो Benami है उसका नाम आप कैसे लोगे, right? So the point is, this Benami property disclosure is required, and this Benami property comes under the Benami Transaction and Prohibition Act 1988, right? So these sort of disclosure you need to provide in the financial statement, and there are disclosure from the reporting side by the auditor in CARO as well. The detail of the property, the amount, who are the beneficiaries. If property is in the books, then which line item this property is there in the books, right? If property is not in the books, then you have to state this fact with the reasons that this property is not in the books, and these are the reasons, right? So these kind of disclosure is required to be given in the notes to the financial statements as per the amended requirement of the friends. And let me emphasize the word which was there in the amended schedule 3, right? When you look at the amended schedule 3, right, the new requirement like this title deed, like this Benami property, undisclosed income, CSR, the heading, when you look at, the heading is additional regulatory information, right? Additional regulatory information. So you understand this word. Disclosure with respect to borrowings from banks or financial institutions. Friends, if I talk about this particular disclosure, right? So the changes are, or the amendment is there in the schedule 3 as well as CARO. Friends, the requirement of the schedule 3 is, if the company has taken any borrowing from the banks or financial institution, right, on the basis of security of the current assets. So if it is a secured borrowing, the company has to disclose the following. Number 1, whether quarterly return or statement of current assets filed by the company with banks or financial institution are in agreement with the books of accounts. Friends, if you are the auditor of a listed company, these listed companies are doing their closing on a quarterly basis, right? Because as per SEBI LODR, as per regulation 33, they have to file their results to the SEBI. And as an auditor, either you are auditing or you are doing a limited review. Okay, so they are closing their books on a quarterly basis. But if it is an unlisted company and where you're doing an annual audit, probably life would be difficult. Okay, that if the company has taken the borrowings and the company has to submit some quarterly returns or statements, so whether they are in agreement with the books of accounts or not. So let's say the company in the June quarter, the company has submitted, there is a private limited company and it has submitted the quarterly return to the banks. Okay. And after June, they put an entry in the month of June. Okay. And when you are just carving out the trial balance of up to June, or let's say up to September, that return is not matching with the financial books of accounts. So I would recommend, and I would say as an auditor of the unlisted company, probably you need to take a data. You need to take a accounts data, or you need to take a trial balance on a quarterly basis if the company is filing this kind of return with the bankers or the financial institutions, right? So that you will be able to understand what they are filing and whether it is matching with the books of accounts or not. So that is number one. Number two, if it is not matching with the books of accounts, then you have to disclose the summary of reconciliation and reasons for material discrepancies, if any, has to be adequately disclosed. Friends, let me talk about audit trail also. So the requirement of audit trail effective from 1st April 2023 probably will help in some way or other in these kind of aspects, where if management is or the company changing any entry, they are modifying, they are deleting, okay, or they are just altering any records, so they have to maintain the audit trail or audit log of the transaction. For example, on 30th June or till 30th June, if you have passed an entry of X amount, and in the month of July, if you are altering it from X to Y, so probably first you have to have an audit trail having three things. One, what has been altered, who has altered, right? And when it has been altered, right? For 30th June record, for example, the sales entry has been modified. So number one, what has been altered? This sale entry has been altered. Who has altered? The user, Mr. X has altered. So who is the user? Then you will ask that who has given you the approval, right? So right sort of approval should be there. It has to be a very responsible kind of alteration. Number three, when it was altered. So for 30th June transaction, it was altered on 31st July, let's say, right? So what was earlier and what it is now. So probably audit trail will help in some way or other, right, in these kind of things. So coming to the role of the auditor. So as the role of the auditor in the CARO, you are required to disclose, or you are required to provide this fact in your CARO report if the working capital is in excess of 5 crores. But for a company, there is no such limit. Even though if the working capital is 1 crore, still you are required some disclosures. Coming to the next part is a willful defaulter. And friends, RBI used to release the list of willful defaulter on a regular basis. So if a company is a willful defaulter, again it's a new requirement which is there for a willful defaulter. So the company is required to disclose in the notes to accounts, and the auditor is also required to disclose in the audit report, in the CARO report, right? Where a company is declared willful defaulter by any bank or financial institution or other lender, the details are required to given, like date of declaration as a willful defaulter and the detail of defaults. Okay. One more important disclosure, the struck of companies, right? So being a member of the ICI, so I'll give you an example to make you understand what is meant by struck of companies. The struck of companies are those companies whose names have been struck off from the registrar of the company's records. Friends, if you will not pay the ICI fees on time, right? Let's say you have defaulted in paying the fees, your name will be struck off from the register of member, right? And the same is with the company also. If the company is not filing their returns, okay, for a certain period of time, so their name will be struck off from the register of the companies. It does not mean that those companies are not active. Okay. Probably their PAN card is there, their GST number is there, but their records, but in the record of MCA, in the record of registrar, it is a struck off company. So struck off company you need to look at from the perspective of Section 248 of the Companies Act 2013 or Section 560 of the Companies Act 1956. What sort of disclosure is required in this case? And you have seen that a lot of companies has done the disclosure, and I've seen that a lot of companies are not doing this disclosure as. Friends, first of all, in this kind of cases, you have to see your vendor and your customer register, right? Even your vendor list or the customer list or the shareholder list, you have to carve out who are the companies, who are the corporate, right? This is only talking about the company. It is not talking about the non-corporates. Then you have to look at that whether it is a stock of companies or it is an active company, right? And of course, if you have a long list of such items, probably you will not be able to identify. In that case, you can outsource this activity. There are so many vendors or consultants who is supporting you in identification of these data. But the bottom line is, what sort of disclosure is required? You are required to provide the name of stock of company, right? The nature of transaction with the stock of company. XYZ Limited, let's say it's a stock of company, and XYZ Limited is your customer. Then what kind of transaction you are having with XYZ Limited? Receivables, okay, if it is a customer. And what is the relationship with XYZ Limited? It is a customer. And what is the balance outstanding? It is also required to be disclosed. Friends, few companies are disclosing the transactions also, right? Although the transaction is not required as per the Schedule 3, but still, if you are disclosing, then it is the more disclosures. But as far as Schedule 3 is concerned, so name of stock of company, the nature of transaction, balance outstanding, and relationship is required to be disclosed, right? Friends, what about CARO in this area? In the CARO, there is no disclosure around stock of company from the auditor side. And this is a disclosure which, again, I have taken from the real life example of Tata Steel. This is the name of the stock of company, the nature of transaction like sale of goods, purchase of goods, receiving of services, and subscription to equity shares also, equity shareholder. This is the outstanding balance as on balance sheet date, as on the comparative date. And this is a relationship, customer, vendor, advance to vendor, equity shareholder, okay? And this is a long list of equity shareholder, right? Number of shares held, paid up share capital, paid up capital as on 31st March and last year, 31st March 21. So now the question is, sir, whether this paid up capital should be at face value or it should be market value. It should be face value. In the balance sheet, you're disclosing your equity share capital at face value, not at a market, right? Equity is never fair valued if it is your equity. Then another requirement is registration of charges or satisfaction with registrar of companies. This again requirement is there in division 1, 2, 3. So there is a requirement for the layer of companies in Companies Act. So you have to provide the compliance with the number of layers of the companies, right? And you have to provide the name of the company, the sin of the companies beyond the specific layers, and the relationship and the extent of holding, right, in the downstream companies. Compliance with approved scheme of arrangement. For example, there is some amalgamation or merger which is happening, then whether the accounting is happening in accordance with the accounting standard on those merger and acquisition standard, right? Or it is as per the scheme of arrangement or not. So this is also required to be disclosed as a part of the notes to accounts. In all these three areas, no disclosure is from the auditor side of the CARO, right? It is more from the management side. Key ratios, again, a big disclosure, I would say. So current ratio, debt equity ratio, debt service coverage ratio, return on equity ratio, inventory turnover ratio, trade receivable turnover ratio, trade payable turnover ratio, net capital turnover ratio, net profit ratio, return on capital employed, return on investment. So these 11 ratios are given in the Schedule 3, notification 24 March 2021. And these 11 ratios are required to be disclosure. If it is not applicable to you, you can write not applicable, okay? But if it is applicable, you have to, you have to say what is the numerator, what is the denominator, and what is the ratio, okay? So you have to explain the numerator and denominator, sir. From where we'll get the formula for these ratios? So ICI has come out with the guidance note on division 1, division 2, and division 3 of the Schedule 3, and ICI has clarified that what could be the formula for these ratios, right? You can refer that, or company can use their own formula as well, which they have to disclose in the notes to accounts, right? Friend, just one thing I want to say here. There are listed companies, and probably you are the auditor and member of the listed companies, and these ratios are required to be disclosed in the quarterly results of the listed companies. If they are debt listed companies, so as per regulation 52, and if I correctly remember, regulation 52 sub-regulation 4 or sub-regulation 8 talks about the disclosure of some financial ratios, right? Like debt equity ratio, okay? So friends, in that case, you must have to align your annual report along with the ratios which you are publishing in your SEBI results, right? So within a company, if you are using these ratios into a different public platforms, so probably it should be consistent, right? Like in MD and a management discussion and analysis report, there are some ratios are there also, right? So you have to use the same. So this is just a recommendation and guidance from my side. Friends, if the ratio is more, the change in the ratio, the variance is more than 25%, again, the reason is required to be disclosed, right? In some cases, we have seen that it is more than 25%, but the management has not been disclosed those reason of the variances. So it has to be disclosed, right? And being an auditor, you have to see that if it is more than 25%, so the disclosure should be there from the management in the notes to accounts. This is a real life example on the ratios. So these were the larger things which I wanted to discuss on the schedule 3 with the correlation with the CARO 2020. So friends, then there's the utilization of borrowed funds and share premium, that if you are taking a borrowing, so what sort of utilization you are doing, whether you are acting as an intermediary, you are passing on your borrowings, or you are utilizing for the desired purposes. I think again that is a very important disclosure, okay, which is required to be disclosed as per schedule 3. For section 8 companies, there is a small disclosure between the revenue from operations and other income. If you have a grants or donation, it has to be disclosed as a separate line item in between. For undisclosed income, I have explained you that the company shall give the details of any transaction not recorded in the books of accounts, which have been surrendered or disclosed as income during the income tax assessments, right? Under the Income Tax Act 1961, okay? Unless there is an immunity for disclosure under any scheme, and shall also state whether the previously unrecorded income and related asset have been properly recorded in the books of accounts during the year, right? So friends, if there is a, let's say, there is a voluntary disclosure scheme, so that scheme comes under Generally Finance Act, okay? So it does not comes under Income Tax Act. So if you'll ask me as a requirement of Schedule 3 or from the on a CARO from the auditor side, whether this voluntary disclosure scheme things has to be disclosed here, answer is no, probably from my side. Corporate social responsibility, I have briefly explained that the disclosure have been enhanced in terms of corporate social responsibility. So looking into this ESG and the other requirement of BRSR, this CSR is also getting evolved over a period of time. So a lot of disclosure requirement is there. So what is the amount which is budgeted, which you are calculating as a 3-year average profit, right? 2% of the 3-year average profit. So what is the amount which was required to be spent? What is the actual spent? If there is any shortfall, if there is any previous year shortfall, right? The reason for shortfall, the nature of activities, the detail of related party transaction. For example, the company has its own trust or own NGO. So if it is a related party, so that is also required to be disclosed, right? If the company has made a provision with respect to a liability incurred by entering into a contractual obligation, again, the movement of such provision is also required to be disclosed. The last one is the details of cryptocurrency or virtual currency, right? If the company is dealing in cryptocurrency or virtual currency, probably you have heard that few companies have started, transacting into the crypto or virtual currency. In that case, outside India, you must have heard that. So the disclosure is also there with respect to the crypto or virtual currency, that what is the profit or loss on transaction involving cryptocurrency or virtual currency? What is the amount of currency which the company is holding on the reporting date, and the deposit or advances from any person for the purpose of trading or investing in the cryptocurrency or virtual currency. These were the important amendments which I want to cover along with the CARO. So now I'm concluding my deliberation on Schedule 3 and CARO. Friends, if you have any question, so I'm happy to answer that in the next 10 minutes. My number is 999991543. If you have any query, you can just reach out to me.
Queries in the chat box. Can I share with you one by one?
Yeah, sure.
Yeah. Sir, first one is the whether the changes in the grouping for the previous year is possible to suit to the current year grouping. Like last year reported in the short term borrowing, this year to be reported in long term. Current year we can classify it in long term, but for the previous year, is it should be stated in the short term or long term?
See, so I have a two answer for this case, right? First of all, you need to see the facts of the case. For example, in the last year it was long term, but initially it was shown as a short term, right? So in that case, you have to rectify the last year grouping as well. But the second example is, let's say in the last year it was a long term, but in the current year it become a short term. Why? Because last year beyond 1 year outstanding was there, the repayment was beyond 1 year, but in this year it become less than 1 year. In that case, last year number has to be shown as a long term, and the current year number has to be shown as a short term.
Okay. So second one is, can we say CARO as document on internal financial control and enterprise level control?
See, first of all, CARO is not the document of the management. When you are talking about the operational control, financial control, or entity level control, it is something which is made by the company. CARO is the document of the auditor, where the auditor is reporting on the financial position, financial performance, governance, compliances, and on the other areas of the company. It is not the company's document.
Sir, next one is, I think already this is covered, how to interpret the rounding off in case of preparation of financials. I think it's already covered. And next one is why DTA and DTL is always non-current.
Yes, so technically speaking, right, and in my example, which I have taken, for example, on 31st March 2022, you have taken something which is your non-current. Okay, and first of all, you will close your books of accounts. You will close your books of accounts on 31st March 23 in the next year. When in my earlier example, in which I have said that the company has a huge profits and this DTA is recoverable. Okay. So you are closing your books of accounts for 31st March 23, probably after 31st March 2023, and you will file your return of income. When you will complete your books of accounts, you'll file your return of income later on, probably by July or by September, October, right? Whatever the case may be. So when I'm saying the right to recover, of course, you expect that right to recover is there, but it is something your right will come when you will, for example, your income tax losses, right? It has to be adjusted from the current year profit. And who will allow that? So it is as per Income Tax Act. So probably this right, you will not get this right if you will not file your return of income in time, for example, right? So you cannot carry forward the losses. So your right will be provided when you file the income tax return, and of course it will always be more than 1 year. So that is why the call was there that it has to be non-current.
Okay. Okay. So second last doubt was, has the I will start from this. If the financial as per Schedule 3 and CARO cover all problem, then why the banks are asking CMA data for every loan application and or renewal? The CMA is compiled based on same financial, and is not this Schedule 3 sufficient?
So first of all, you need to understand the difference between the CMA data and the difference between the CMA data and the financial statement. When you look at the financial statement, you are writing balance sheet as it. So your financial statement, your CARO, your audit report is always commenting on the financial position as on the reporting date. When you talk about CMA data, as far as my understanding is concerned, CMA data, of course, you are preparing the CMA data for the future, right? What will be my next year revenue? What will be my next year profit? How my next year balance sheet will look like? So this is an estimated number. This is a budgeted number which you are forecasting for the future years. Financial statement and the opinion on the financial statement is always backward, right? The auditor are doing postmortem. Okay, so once the reporting date is over, the financial statement will be handed over to the auditors, and they are auditing on those, or they're auditing those financial statement, which is for the year ended, for the quarter ended, and that is why the word is not ending. The word is ended. The word is as it.
Okay.
So you cannot say that both are the same thing.
Sir, last doubt of the session is, a company under Section 8 of the Companies Act 2013 following cash system of accounting. If an MSME unit has given an invoice for the service done to the company and remain unpaid for more than 180 days, what are all the remedies available to the MSME under the Companies Act 2013? What are all the way the companies violated the provision of various laws?
So first of all, I'm not commenting on the cash or accrual basis of accounting, but let me answer the MSME part, right? So if there are dues which are payable to MSME, you have to comply the provisions of MSME Act 2006. Number one, if MSME entity has raised the bill and you have accepted the goods and services, you have accepted the bill, you have to pay within 45 days. That is number one. If you are not able to pay within 45 days, MSME entity is liable to demand an interest at the rate of 3 times of the bank rate, which you are obligated to pay, right? Coming to the compliances, of course, if you're not paying in time, is it a non-compliance? Answer is yes, it is a non-compliance. But what is the remedy for this non-compliance? Of course, you are end up paying at a more amount, right? You end up paying I would say interest, okay? And when you are filing a half yearly return, you have to state that, what are the delays in MSMEs, what are the amount, what are the interest, all sort of these disclosures are required in filing that half yearly return also.
Sir, one more doubt came right now. That is, a company is not paying to its unsecured loan the interest as well as the loan amount for several years. Also, no provision for interest is made in the accounts. At times, they are evergreening the one or two loans parties. What is the duty of the auditor here?
Yeah. So first of all, the first question belongs to the accounting. The second question belongs to the responsibility. The first question talks about that there is an unsecured loan. The company is not paying the interest on unsecured loan, right? And the company is not taking any provision for unsecured loan. So the point is, as per the terms of the agreement, if it is not an interest-free loan, right? The company is not paying does not mean that the company will not accrue these loans. But if the company has entered into a contract with the other party that he will not demand the interest and I'll not pay the interest, if this thing is already, in agreement, probably in that case, you are allowed not to accrue the interest. But if interest is payable, the only thing is you are not paying, does not mean that the accounting will not happen. The accounting will happen, right? You have to accrue the interest. In that case, being an auditor, probably will talk about the non-compliances of the accounting provision, and the accrual basis of accounting is not coming from the accounting standard or Ind AS, although it is coming from there. But if I talk about the basic framework of Ind AS or accounting standard, the accrual accounting is the fundamental accounting assumption. Okay. So if you are deviating with the fundamental accounting assumption, probably there will be an issue. Number two, if there is a evergreening of loans, first of all, if you are taking a loan from ICICI Bank and you are paying to the existing HDFC Bank, right? If these two are different parties, probably things would be different. But if you are taking a loan from ICICI Bank to repay the existing loan of ICICI Bank, then there is a problem, right? If you're taking the loan from the same party to repay the loan to that same party, that is known as an evergreening of loan. So as an auditor, you have to disclose this in the auditor's report. And this is a sub clause which was added in the CARO report, CARO 22.
Okay, sir, this is all about the doubts for today's session. And indeed, it was a very great session, sir. I think you already covered the entire session with all the matter present in Schedule 3 and CARO. And for this, again, I would like to thank for giving us valuable time on behalf of Auditing and Assurance Standard Board of ICI, as well from Bhatinda branch of ICIS, sir. And thanks a lot, sir, for joining us today. Thanks a lot.
Thanks to AASB for giving me this opportunity. So I would say this was a learning session for me as well.
No, sure, sir. Sure.
Thank you.
Okay, sir. Thank you.